In this market, the real danger is never the pullback itself, but the way you slowly give up your defensive awareness during an uptrend. The indexes keep printing new highs, while the VX rises at the same time. That's not money retreating. That's money actively raising its survival rate. Today, we're doing just one thing, to see clearly how the market is repricing risk. Hey everyone, I'm Peter. Today is January 8th, 2026. Let me start with something I think a lot of people will nod to. Lately, this market doesn't look bad, but deep down, you just don't feel settled. When it goes up, you don't dare to add. When it pulls back, you don't dare to short. If you feel that way, it actually means your read on this market is right. The indexes have pulled back while sitting at historical highs. On the surface, it's easy to interpret this as a top signal. But if you put the index action and the VX together, you'll notice a very typical and very easy to miss combination. The indexes are still holding at high levels, while volatility is creeping higher. This combination usually shows up in the middle to late stage of a strong trend, not right before a trend ends. But what does real panic actually look like? It looks like indexes dropping hard and fast while the VX goes straight through the roof, not indexes slowly climbing while the VX slowly grinds higher. It's more like you're on the highway. The road conditions are still okay, but things ahead start looking more complicated. So you instinctively tighten your seatbelt and lightly rest your foot on the brake. ADP payrolls improved, but came in below market expectations, and that outcome is very worth thinking about. It tells you the economy is repairing, but it's not re-accelerating. The labor market is neither clearly overheating nor rapidly stalling. At the same time, rate futures still price in multiple cuts in 2026, which means the soft landing core narrative has not been overturned. You can say the economy is good, but it's not good enough to get anyone truly excited. You can say it's bad, but it doesn't look like it's about to become a real problem either. So what funds are doing now isn't loading up heavily on direction. They're waiting for a signal that tells them, now you can move. Whether January brings a rate cut is no longer just a policy question. It's more like an emotional anchor for the market. This pullback in QQQ, if you only stare at a few short-term candles, it's easy to conclude the breakout failed. But if you zoom out, it looks more like repeated probing for direction at the end of a triangle. Earlier lows kept stepping higher, which shows capital hasn't left. Yet every time price touches the upper boundary, it gets pressed back down, which shows bulls also don't want to force a statement ahead of the data. Even more important, volume did not expand meaningfully during the pullback. What drains you most in this kind of market isn't the loss, it's the mental pressure. You always feel like you're just one step away. If you chase, you're afraid you're chasing high. If you don't, you're afraid it takes off without you. A lot of people, in this exact phase, push their trading frequency to the maximum, and that's how they end up scrambling themselves. You have to accept a reality. The end of a range is meant to grind people down. This pullback in the S&P 500 can't be fully explained by it's gone up a lot. It's time to rest. What you really need to watch is whether capital behavior has undergone a qualitative shift while the index is at high levels. Structurally, the index is still inside a clear upward channel. After the pullback, it has not broken the key trend line, and price is still trading above all medium-term moving averages, which means the trend has not been damaged. I know a lot of people are extremely sensitive to the 7,000 level right now, like if it can't hold, something big is going to happen. But think about one thing calmly. Real market tops usually don't form right when everyone is staring at the same level. What does this feel like instead? It feels like a group of institutions slowing down at the door, looking at each other, confirming whether they should charge together or wait a bit longer. The drop in precious metals looks very emotional, especially when you get consecutive sharp declines in a short window. It's easy to interpret it as money is collectively turning bearish. But if you shift your focus from price to the source of the flows, the logic looks completely different. Margin adjustments at the Shanghai Futures Exchange mostly amplified volatility. The real core pressure came from BM index weight rebalancing. This kind of precious metals market can wreck your mindset. You keep asking yourself, did I miss some huge news? Does someone else already know the outcome? But the reality is, what you're seeing is not smart money running away, it's passive money moving houses. Those are two very different things. When passive funds leave, they don't care about levels and they don't care about emotion. Bitcoin's current pullback fits a structural correction after a strong year-start rebound, rather than a decline led by risk-off emotion. In a typical risk aversion phase, you would see the dollar index and short-term treasury yields strengthen together. While high-risk assets broadly come under pressure, the key is still the $90,000 pivot. As long as it hasn't been decisively broken, you can't call the trend damaged. MSTR's behavior is essentially a leveraged mapping of Bitcoin's volatility, not an independent story. I've always felt the most interesting thing about Bitcoin right now isn't whether it's going up, it's that it's getting harder and harder to pretend it doesn't exist. A lot of people say they don't believe, but their body is honest. In their account, it's either coins or MSTR or some related exposure. That tells you something. It has already become a node in the capital relocation system. The most obvious feature of the AI storage chain is how quickly pullbacks get absorbed. That tells you the market's valuation logic has already moved beyond the traditional cyclical stock framework. In the past, storage demand came more from consumer electronics and traditional servers, highly volatile and strongly cyclical. But in the AI era, training and inference demand for high-performance storage is showing sustained, rigid characteristics. A lot of people fall into one trap when they look at storage. They keep trying to fit new structure into old experience. When it goes up, they call it a bubble. When it goes down, they call it the cycle top. But if AI is truly going to scale, storage is not something you can route around. You don't have to like the size of the move, but it's hard to deny its weight in the system is getting heavier. The divergence inside the AI chain is fundamentally a divergence in pricing power. Core players like NVIDIA, AMD, and AVGO can translate cost changes into price changes and can even reinforce scarcity narratives through pricing. Server OEMs sit in a completely different position. Storage costs make up as much as 40%, 60% of BOM, so any upstream price increase directly erodes their margins. That's why I keep emphasizing this is no longer a phase where A broadly rises, but a phase where AI internally stratifies. You can't just hear everyone talking about AI and assume the logic is the same. Different positions lead to different outcomes. Upstream price increases are a benefit, downstream price increases are a burden. What the market will do next is keep using price action to magnify that difference. The sell-off in the power sector is often explained as efficiency improvements reduce demand, but that logic ignores the speed of scale expansion. Data centers have not slowed down. They're expanding rack counts and increasing power density. Even if single bushing efficiency improves, as long as overall scale keeps growing, total power demand can still rise. The short-term pullback is more likely driven by company-level pressure, acquisition-driven debt, earnings misses, and a re-evaluation of capital returns under a high-rate environment. Efficiency improvements do not mean demand disappears. In the real world, it's often the opposite. If your car becomes more fuel efficient, do you drive less or do you go farther? Data centers are the same. In the short term, the market is running the numbers. In the long term, the market is looking at resources. Power has never been a linear story. The real estate and mortgage space is showing very clear structural divergence. Policies restricting institutional purchases of single-family homes directly weaken the expansion of the institutional landlord model, but may also free up supply space for individual buyers. At the same time, mortgage demand is showing signs of recovery, but under high rates that recovery is not uniform. Capital and demand will concentrate more in entities with stronger balance sheets and stronger financing capability. Real estate right now is very hard to summarize with a simple bullish or bearish. It's more like an elimination tournament. If your cash flow is stable, you live. If you rely on emotion and leverage, you get eliminated first. If you still want opportunities in this space, you shouldn't be looking at sector direction. You should be looking at who can make it through the cycle. I'll close with one sentence. The market isn't turning bearish, but it's teaching you how to defend at a higher cost. If you still define winning and losing by up or down, you'll get more and more exhausted. But if you start using structure, thresholds, and capital flows to understand the market, it becomes much clearer. I'm Peter. Thanks for watching through to the end. See you next time.